Today's conversation comes from a September 18th episode of the BMO Equity Research Metal Matters podcast, featuring Helen Amos, commodities analyst at BMO Capital Markets. Metal Matters discusses the hot topics in global metals and mining each week.
Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/Markets Plus for more episodes.
I joined this fantastic team back in May, having been a commodity strategist elsewhere on the sell side. And before then, I spent a lot of time in a mining company. I've seen many different flavors of cycles now and so many different ways of approaching commodity price forecasting. But what I really love the most is exploring the stuff that's difficult to see, the stuff that's less talked about. Things like scrap, grades, reserves, mining investment, China's impact on global development and the financial system, and why supply-demand balances just often don't work for price forecasting. So where to start then? Let's have a quick recap of where we are so far in the year. So at the start of the year, it was all about the doom and gloom. Everyone was staring at the prospect of tariffs from the US and coming to the conclusion that, however unknown, tariffs and the ongoing policy uncertainty would inevitably put a serious dent on the global economy. This would hurt demand for metals and with that prices. But the reality so far couldn't be more different. In fact, across many of the major metals, we've seen quite decent year-to-date price gains. LME copper up 16%, aluminium 6%, iron ore 9%. And of course, how can we not mention the precious metals? So this has been the second year in a row of strong outperformance versus the other mine commodities. So gold so far up 40%. Silver 47%, and platinum an incredible 54%. But it hasn't been all one way for the commodities, though, notably the coals. They've really struggled to pull out of the cost curve this year. And zinc, nickel, they've lagged the pack too, both essentially flat from the start of the year. And of course, there have been bumps along the way. Notably, we had that big sell-off post-Liberation Day and then subsequent rebound. But I have to say, not many people I spoke to at the start of the year, facing the macro backdrop of tariffs that we've seen, would have guessed copper would be back above 10K, or even iron ore back to 105, that's for sure. So what's going on? Why have metal prices been so strong this year? Well, let's start at the macro level and tariffs. Well, the US tariffs, they're finally here now, and August saw a huge number of country-specific trade deals. Now, most of the tariffs were agreed somewhere in the region of 20 to 30%, lower than the Liberation Day figures, but still significantly above any level in recent history. The US and China, they've extended their tariff truce period once again until November 10th. But even so, there is still a 30% rate on most Chinese exports to the US and a 10% rate on US goods into China. And then let's not forget the metal-specific Section 232 tariffs on steel and aluminium. They were both lifted to 50% in June. And then a few weeks after that, we had the 50% Section 232 tariff applied on copper semis and derivative products. Importantly, not on refined metal, and that caught a lot of people in the market by surprise. Now, the textbook says that tariffs mean additional costs, and that means inflation, even if it's one-off. And potentially that brings demand destruction with it. But it's just taken some time for all of this to play out. Now, we did have some earlier front-running and stockpiling ahead of tariffs. That's been one factor, and it's meant manufacturers have been able to use lower cost inventory for a while. But it does also look like some manufacturers are absorbing the cost hit in their margins rather than fully passing through the cost to consumers. And finally, I'd say rerouting and even substitution are probably helping to dampen the impact so far too. Saying that, cracks are finally starting to be seen in hard economic data in the last few weeks. So in the US, we're seeing undeniable evidence of weakness in the labour market. In Germany, factory orders slumped the most since January. And in China, all important for global commodities, export growth fell back to only 4.4% in August. That was much slower than the 7.2% in July. And both industrial production and fixed asset investment growth are slipping too. So, with signs of strain so clear now in the data, why then are commodity prices still quite strong? Well, let's start with the dollar. Essentially, US dollar weakness that has played a very big role this year. The dollar index has come under a lot of downward pressure over the first half of this year as US policy changes have created concerns over economic growth, inflation, and public debt. Now, the DXY index is already down a lot year to date, but further weakness does seem inevitable as the US now moves into a rate cutting cycle. Now, whenever the US dollar weakens, it makes commodities, which are usually dollar denominated, more affordable for importing countries, in theory, supporting demand. And then likewise, US dollar weakness or producer currency strength adds upward pressure to the mining cost curves in US dollar terms, and in turn, upward pressure to prices. And finally, US dollar weakness, that helps emerging markets in servicing their US dollar denominated debt. That improves their balance sheets, makes imports cheaper, and so gives them more room for spending and investment. And we have to remember that emerging markets, these are really the engines of global metals demand. So when they do well, metals do well too. And it goes without saying that gold is a particular beneficiary of dollar weakness and rate cuts, as well as the ongoing concerns we've had over policy uncertainty and the Fed independence. Okay, let's talk a little bit now about supply. Now, supply disappointments are not a new phenomenon in mining, but copper has certainly had its fair share in the last couple of years. Now, in recent months, we've had a number of incidents, including at Kamoa-Kakula, Codelco, and Grasberg, which have led to supply disruptions. But what strikes me is just how low global stocks are at the moment relative to the level of global demand. Now, CRU, for example, estimates that global copper stocks stand at about 25 days worth of consumption today. That compares with about 35 days pre-pandemic. So we just don't have the buffer anymore to absorb disruptions when they do happen. Now, this is all creating tightness in concentrate markets. That's causing smelters to draw in more scrap than they would otherwise be doing so, and that's all helping to push up marginal costs and supporting prices. Now, ultimately, I think this all comes down to the mining sector's investment response. Now, this has arguably been lagging behind what is needed to replenish depletion and keep up with incremental demand growth. So that's all contributing to this lack of mine capacity buffer in the system, leading to this concentrate tightness in some of the commodities that we're seeing today. Now, with big M&A back on the agenda again this year, this is certainly putting the spotlight again on the challenges that miners are having in finding decent organic growth. But it's not just about copper. We're also seeing clear signs of this emerging in other markets too, like PGMs. We're actually seeing now big annual deficits in platinum, and that's because we've had low investment in the supply side, and we're actually seeing now annual declines, for example, in mine output from South Africa. And this was discussed in some detail in a great report from my colleagues George Heppel and Frederick Bolton. And staying on the supply side, in iron ore, I think everyone's been so worried about the impact of the Simandou project ramp up in Guinea that I think maybe they've lost sight of what's going on with supply in the rest of the world. And what we're seeing is actually accelerating depletion from some of the older operations in Australia and Brazil. And I think what's really interesting is that India has actually again turned into a net importer of iron ore this quarter. And we're seeing some new regulation there around the auctioning process that's adding additional costs on to the domestic miners and reducing their global competitiveness. Now, I've always liked to consider domestic sources of supply when I look at the bulks and the global supply curve, as I think, all supply matters ultimately in price formation. But in the bulks, there has been this tendency to just look at seaborne volumes. And I think that actually misses some very big pieces of the jigsaw puzzle when we're looking at the bulk commodities. And China's very much part of the supply equation too. Now, if you remember this time a year ago, all of us were focused on China's huge surprise demand stimulus. But this time, everyone's now focused on their supply side policy. So that's the big anti-involution buzzword that everyone's now talking about. Now, in our view, and we put out a recent piece on this, we think that these reforms have the potential to move the dial globally the most in coal, specifically met coal, and also potentially refined copper. But we would also probably watch out for any incremental rationalization that we could see in steel, which could boost margins further there, which would help with iron ore quality differentials. Now, another important shift I think we're seeing at the moment relates to national security. That's affecting commodities across the board, I think. Now, this new era that we find ourselves in of geopolitical fracture and trade tensions and ongoing conflict, that seems to be sharpening everyone's focus on supply chain security. Now, we think we're seeing some signs of regional stockpiling in China now of copper, gold, coal. And I wouldn't be surprised if actually that's one of the reasons why apparent demand for copper has been so much above trend this year. And it's interesting that US COMEX stocks of copper and silver, they're still building without really a particularly negative impact on price yet. Now, putting all of these factors together, so dollar weakness, strengthening emerging market demand, lagging mine investment, and anti-involution stockpiling, I think some could be forgiven for starting to wonder not only whether prices could hold up for longer, but whether we're now moving into a more sustained upcycle for commodities. That said, I do still hear some caution that maybe the great tariff impact is just being deferred into 2026. Thank you for listening to Metal Matters this week, and I'm really looking forward to you joining us for more episodes.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.